Hello and welcome to the Recruit Rockstars podcast, where we focus on the people part of private equity and venture capital portfolio companies. I'm your host, Jeff Hyman, and I'm super excited today to welcome to the show an executive partner and an expert in organization and human capital management, especially with regard to private equity, and that's Andy Caine. Now, let me tell you briefly about Andy. Andy is with Fraser. If you're not familiar with Fraser is, for 30 years now, been one of the leading providers of growth venture capital to healthcare companies, $4 billion or more under management. And I think they've invested in coming up on 200 companies, which we're going to talk about with Andy. They've got both a growth buyout side and then a life sciences, kind of more of a venture side as well. But let me tell you briefly about Andy. He's been advising companies and assessing talent for years. He's done hundreds and hundreds of assessments of leaders and leadership teams. So he has forgotten more than most people will ever know about this, including being at McKinsey Company and then becoming a partner at Green Peak, where he really focused on organizational due diligence. So now he kind of does that within private equity at Frazier. So with all that, welcome to the show, Andy. How are you?
Great. Thanks, Jeff. Thanks for the opportunity.
My pleasure. Thanks so much for being on. I don't even know where to start. You know so much about this stuff. Why don't we start, I guess, at the 30,000 foot level? You work primarily with CEOs and leaders at private equity portfolio companies. Do you do that prior to the investment or after, or both?
I think one thing that makes our program a little unique, Jeff, is I would say 70% of my work is between submission of LOI and 180 days after close. And so, when I was working at Green Peak and seeing a lot of different, everyone runs their sort of human capital practice or operating group a little differently.
Yeah.
And a lot of firms are sort of in the fix-it mode, which is, you hire a former recruiter, and then when a management team isn't successful, they go to the recruiter and say, hey, can you find me better talent or upgrade this talent, or those sorts of things.
Right. And so you're able to identify issues before they happen, reduce the impact on the business, all kinds of ROI, right?
You think about what used to be a 6x multiple became an 8x multiple, became a 10x multiple, and now it's 12 or 14. And if you're in SaaS, it might be 20, right? Or if you're in autism, it might be 20. And so what used to be nice to do have become table stakes if you're going to continue to produce distinctive returns for your LPs. So our philosophy is, it's absolutely essential to put the right people with the right organizational infrastructure and the right culture on the field as close as possible. And the only way to do that is to really get involved up front. So the things that our team does is we sit in on almost every management team presentation that looks like it has legs. Mm-hmm. So like on Friday, I'll be sitting in a management team presentation with the deal team. Yep. And out of that, you say, in order to make this investment successful, what do we think has to happen from an organization and talent standpoint, right? That could be a part of an acquisition. Could be upgrading the sales team. It could be putting in sales operations. It could be a new compensation structure. And then we sort of have a set of hypotheses around that we test during diligence. So myself and my team, we do an organizational due diligence. And we sort of call it a quality of org. We have this classic, like, you would never do a deal without a quality of earnings report.
Yeah.
But yet we do deals all the time in private equity without really understanding the organization. So that's sort of our part of that.
How do you do that in a way that's not off-putting to the prospective investment or acquisition? These are control deals or minority, or both?
They can be both.
Okay.
More often they're controlled. I would say 80%, 90% of our deals are controlled deals, but it can be both. And when I was at Green Peak, we did it for minority deals as well.
I would think that some leaders, some CEOs might be a bit nervous about.
Go ahead. It's a great point, and it's something as a consultant, I had to overcome all the time. It's interesting because but CEOs understand you have to do a quality of earnings report, right? There's no question about that, right? Even if you feel uncomfortable, you're gonna do it.
Yeah.
And so our mindset is, we want to help you be as successful as possible, as quickly as possible. And the only way we're going to know that or how to help you is sort of you tell us what investments, and we really make it. What helps, Jeff, is that we're pretty much only growth oriented. We don't do turnarounds.
Yeah, that does help. It lessens the sensitivity a bit.
Yeah, it lessens the sensitivity a bit, right? And we tend to go in with the assumption that we're going to keep the main tenets of this management team unless they said that. Now, we might not, but the assumption is we're going to do that. And so the real question is, to be successful and continue this growth trajectory that you're on, what investments do we need to make in org and talent? And then how do we phase those investments so that, as you know, like too little or too much too soon can be as bad as too little too late.
Yep.
And so we have to, and people generally agree that if we're going to make investments, we want to make them early so that we can realize the value of that investment within the investment life cycle.
When you think about the companies that you've looked at, not just invested in, but actually just evaluated, what are 2 or 3 of the most common either gaps that you see or shortcomings or opportunities, however you want to put it? What are the most common ones that the listeners would say, I should really get ahead of this and work on this?
Yeah. It's so bespoke that I threaten to say, like, if I say they're the 3 most common, that might make up 40%, as opposed to the 3 most common make up 95%.
Yep.
Examples of that would be people that are generalist athletes that have been playing too many roles, and in a more sophisticated organization probably should only play a more specific role.
So as the business scaled, the business didn't go out and find specialists.
Yeah, so you have the person that was over BD and sales and marketing.
Yeah.
And really they're just at their core, they're an enterprise salesperson.
Right.
And you can play around with that all you want and try to make it, but at some point you just have to have a core conversation that says, Jeff, you're a great enterprise salesperson. Let's just have you do that.
Yeah.
That's an example.
Yep.
Another time you see organizations that have done a lot of acquisitions, but never really integrated those acquisitions.
Yeah. So a roll up, for example.
Yeah.
Yeah.
And out of that, their compensation programs may be inconsistent. And maybe you see compensation programs that are not actually incentivizing the right behaviors, right? Whether that be sales, whether it be finance, and how they work together. And so you've got to resolve that, or else it's a constant thorn in your side.
Right. And is that typically because the CEO is too busy or just didn't want to do it or didn't get to it?
Could be either.
Yeah.
It could be either.
Yeah.
A lot of time it's, I don't want to break the apple cart as in the lead up to, in lead up to a potential deal, right? There's just, if you come in, it looks too messy, right? It's just, you're going to devalue it. The truth of it is you probably should have started that process. We'd probably value it as long as you were starting it, down the right path.
When you look at a prospective deal and you're not convinced the CEO is the right individual to lead the business, or maybe they have been, but now you think about doubling, tripling, quadrupling, they may not be that right person. Do you walk away from the deal, or will you say, we'll still make the investment or acquisition, but a condition of it is a change of the leadership?
Yeah, typically we will, there's almost always a situation where a deal makes sense. And we're there because there's some aspect of the deal that we really, really like. So we're going to give a shot at trying to make it work, right? And occasionally that's a drop in price. Sometimes it's these changes. The biggest thing that I've found is people are much more amenable pre-deal than they are post-deal, right? And I'm even admit this, right? After you win Powerball, you look at life entirely differently. And what most private equity firms, my former clients, would do is they would say, Andy, we love this work, but we want to do it after close.
They don't, right? Because they don't want to have the tough discussion or something.
They don't have the tough discussions. They're worried about losing the deal. The problem is when you wait till after close, it's so much harder than just saying, hey, Jeff, these are the things we have to do before we sign.
It's like you got married and you forgot to date.
You forgot to date, right? So now you're married and now you're having all these tricky conversations. So what ends up happening is, hey, why don't you take Jeff to dinner and then I'll follow up on conversation, and then it gets rescheduled. And you might be 9 months down the road before having that tough conversation around how Jeff should just be the enterprise sales guy and not over business.
You can lose a lot of time, which means real value creation that's not happening.
That's right. And that time has a huge opportunity cost. And once you get off your plan in this cycle where a lot of firms are trying to, their investment cycle might only be 3 to 5 years. If you lose that first 9 months, just think of how much you have to overperform your model to make it up in this back.
It becomes almost impossible.
Almost impossible, right? And so the real question is, if you don't want to have the conversation, do you really want to have that deal under those terms? And we've come to grips with Frazier that, and oftentimes the answer is no. So we should just have the conversation. Because at the end of the day, what's nice is that, our incentives and the management team's incentives are generally aligned. right? When we make money, when our LPs make money, they make a lot of money.
Right.
So we just have to, when you keep that at the core, it's worth having the conversation.
And when the CEO or the leadership team is not open to it, then better to find out and you can walk away.
Yeah. I mean, that's exactly the right point. You got to wonder if someone is either doesn't want to be aware of the team's shortcomings or their own shortcomings. Is it the right person to partner with? I would say the companies that we do the best, this is, it's interesting because the research sort of bears this out. When you look at the research in leadership development, there's a lot of what I call soft data. There's a lot of soft correlations, but one thing that's consistently highly correlated is that leaders that have very high self-awareness and a growth orientation to themselves tend to outperform their peers.
Is that as simple as EQ, or is that something else?
I think it's something else. I think there's an EQ component to it, but there is just a natural curiosity around looking at myself in the mirror with the bright lights on.
Yeah. Which not everyone can do.
Comfortable with that.
Yeah.
Yeah. Being comfortable and running towards their development areas and looking to complement them as opposed to avoiding them and running away from them.
You've done so many assessments of executives over the years, CEOs and otherwise. I'm curious, what are the most unique, or what are the key differentiators that when you see them, they're markers almost, you just know this person is going to be successful or find a way to be successful? What are those few things that are hard to find, but you're trained to look for them?
Yeah, just one thing is that every scorecard, every assessment, we do a scorecard. Every scorecard is bespoke. So we start with a what. I mean, there are some commonalities around CFOs. There's things that you have to do, right? Yep. But every scorecard is bespoke. But then on top of that, there is these sort of 4 factors that I always look at, even if they're not on the scorecard.
These are kind of the common DNA that you look for.
The common DNA. So one is self-awareness. So
the one you just talked about. Yep.
Talked about. And what we're looking for is not have someone succeeded or failed in the past, but do the areas where they say they've succeeded or failed align with their reference checks? And so that's always sort of zoned in. And if that's not true, then why is that not true?
Yep.
What I call resiliency. So there's a lot of people that have been, in this field that are really, really talented, high successful people, right? And they went to Harvard, and then they went to Goldman, and then they went to, and then they became an operator and those sorts of things.
Or they scaled a business from 2010 to 2017 without a dip or anything.
Without a dip or whatever. And I want to see someone that really had to fight through a tough situation, because a CEO at a private equity firm, I've yet to see one where we executed exactly to plan.
Yeah.
And the strategy held true throughout the whole investment.
Never happens. Yeah.
Never happens. So you got to have someone that can pick themselves up, pick their team up, and work through adversity, right? And you don't want it to be the first time. Integrity is and transparency, and I sort of tie them together, right? So I came from West Point, so the whole cadet will not lie, cheat, or steal, or tolerate those do, and then it's beyond that, like how do you do the harder right rather than easy or wrong? And I use Kohlberg's moral reasoning as a way to sort of vet that out. So does someone at their core, do they optimize for themselves? Do they optimize for their team? Do they optimize for just the rules? Or do they optimize around the spirit behind the rules? And so I'm looking at for ways in which people make decisions.
And how do you get at that in
it's amazing. Just ask the right questions around decisions. So why did you make that decision? So I'll use an example of one that sort of stands out. So I was doing this CEO assessment for a big private equity firm a couple of years ago, and I met with this leader and the CEO that was in Singapore. And one of the key decisions he had made was moving the EMEA office from Frankfurt to Singapore when he was head of the EMEA office, which was interesting because Singapore is not even in EMEA.
Right.
And so I asked him why that was, and he said, well, we had some clients in that region that I sort of wanted to develop. But also, real factor was my wife wanted our kids to go to school in Singapore because of the strength of the Singapore schools. Right. So it's like a little thing that you could almost miss.
Yeah.
But you got to what was that person optimizing for in that moment?
You got to ask the follow-up question, which is not just what was the decision, but why did you choose that particular decision?
It's really the why the decision. I ask a lot of questions. So the decision itself, I'm not judging. Right. What I really want to understand is the rationale.
Yeah.
The rationale behind the decision, right?
And what was the fourth one? You said there were 4, I think.
Yeah, it's this growth orientation. It's sort of this commitment to self-development. And so someone that seeks feedback, right? It sort of ties in, it enables self-awareness, but it doesn't always equate to self-awareness. It's sort of a stepping stone to self-awareness.
Yep.
Even people that are self-aware, not all of them really have a growth mindset where they're constantly looking for development. So, yeah.
And so when you assess an executive and they're missing one or more of those four things, those common DNA, which I think is brilliant, Andy, because happen to agree with them, and they're not role specific.
They're not role specific.
Right.
Right.
What do you do? Do you walk away from that investment? Do you say this leader's never going to be the kind of leader that we need for the business, or what do you do? Because not everyone has those four things.
And they have them to different degrees, right? And that's one thing, especially around integrity, I want to say. We have this misconception that there's like 98% of us are Boy Scouts and Girl Scouts, and then there's 2% of bad apples that we can find and root out.
Yeah.
The great book by Dan Ariely, that those that haven't read it, called The Honest Truth About Dishonesty, where it actually proves that we're all on a bell curve,
It's a spectrum. Yeah.
It's a spectrum, right? And so we're someone sort of lower on the spectrum. The question is, can you put in either complementary talent or risk mitigators to mitigate it, or can you provide coaching, and can you provide coaching on those dimensions?
So like put guardrails in place so that they can't get out of those areas.
That's right. So you could think about, if there's a question around transparency, you can set up the frequency around board interactions sort of be higher. The information they're required to provide the board, the types of information they need to present the board before a key decision is made, right? So that's one. We probably wouldn't compromise on integrity, but around self-awareness, we basically say, hey, at the 6-month mark, we're going to do a 360. We're going to develop your scorecard up front, and then we're going to do a 360. We're going to give you that feedback. So we're basically in a process that's going to enhance their self-awareness, even if it's not something they're naturally oriented towards. So there's a sort of a playbook to sort of help people move up the spectrum. But once again, if you're at the 2% on the low end, right?
Yeah. Yep.
You're probably not the right type of leader for us.
I want to touch on one last topic before we wrap up, which is CEOs and their ability to hire. So again, you've met so many leaders. What percent of them would you say really know how to do this? Like you're describing, know how to assess their own staff members or prospective candidates and hire for optimal results?
Well, I think that the statistics would show, depending on what study you look at, it's somewhere between the 52 and 58 percentile.
It's pretty bad.
Yeah, it's pretty bad, right? And so what I find a lot is that CEOs are so busy and they have so much going on that even though they understand its importance, they shortcut the level of diligence that goes into it. And there's also a piece of they're going to be they're the manager of this person, right? And so they really emphasize can I get along with this person, and can I build a relationship with this person?
Yeah. Do I like likability?
Yeah, it's likability, and it's also cultivation. They're optimizing for cultivation as opposed to diligence, right? And so it makes it hard to ask the tough question. And in some ways, I understand that. And so there's a role that we play, or firms like Green Peak play, in that still friendly, but we can ask the tough question and not have to worry about the downward stream of how that's going to impact our relationship. So I can just say, hey, Jeff, tell me about how you failed. Where did you fail in that role?
Yeah.
Right. And it doesn't seem unusual because of the role I play. Whereas for some CEOs, that does not natural coming off their tongue, and it's makes it hard to do.
So it is a big blind spot for a lot of CEOs, but there are other tools and resources in companies that they can use to shore up their ability to really get under the covers of a prospective hire.
Yeah, and it's not just there's a spectrum of options you could. It's not an all or nothing. It's not a 40,000 GH Smart assessment or nothing. Yeah. Right. So there's like behavioral tests like the Hogan that you can run for like $100 and interpretation for like $1,000, and then so there's various depending on how critical the role is, you should sort of scope out how diligent you want to be.
What is the risk? What is the impact of being wrong?
The impact of being wrong is they say 15 times the cost of
the individual. So if it's a CFO and you're wrong, you got a big problem.
That's right. That's right. In so many ways, because it's not just the severance cost, but it's the opportunity cost. It's the, B players tend to hire C players, right? Yep. So then the downstream effect. So yes.
Well, Andy, you are very wise about this stuff. Clearly, it is all that you do, and it shows. How can people learn more about Frazier Healthcare Partners or get in touch?
Yeah, so standard, we have a website, right? So it's FrazierHealthcare.com, and then you can just reach out to me direct. If you're a practitioner in this field, one of the things I love to do is just help people in this field. I want the field of human capital and private equity to sort of advance and evolve the ways finance and business development of other fields have, and I think we're on that course. People are waking up to its importance. And so if you reach out to me at andy.caine@frazierpartners.com, I'll reach back.
Couldn't be any easier. Andy, thank you so much for making the time. We really appreciate it.
Thanks, Jeff. Thanks for the opportunity.